Okay, so you've probably heard the buzz around QQQ, right? That Nasdaq 100 ETF. It always seems to be linked with big tech and all that innovation. I mean, the returns have been pretty impressive. You can't deny that. But is it really the ultimate growth engine, or are there maybe some tech bubble type warnings we should be paying attention to? Today, we're going deeper than just defining it. We want to really dissect what drives it, those unique risks, and what that premium price tag actually means for, your strategy.
Yeah, it's fascinating, isn't it? How the market gets so excited about innovation, but you always have to balance that excitement against the fundamental risks. It's a constant dynamic. So, our mission with this deep dive is really to distill the analysis around the Invesco QQQ Trust. We're focusing sharp on that sort of dual nature it has. You've got this immense growth potential on one side, but then right alongside it, these significant kind of unique vulnerabilities. The goal here is to give you a clear picture, something actionable, and a strategic way to think about this really powerful but definitely complex investment.
All right, sounds good. So let's start at the beginning. For anyone who maybe knows the ticker QQQ but not all the details, what exactly is this thing, and how did it become such a, well, titan in the investment world?
Sure. So at its core, QQQ is an exchange-traded fund, an ETF. Technically, it's structured as a unit investment trust, a UIT. And it's actually been around a while, established way back in March 1999. That makes it one of the oldest and definitely one of the most successful ETFs out there. Its goal, its objective is really straightforward. It's passive. It just aims to track the performance of the Nasdaq 100 index as closely as it can. And it basically does this by holding under most conditions, all the stocks that are actually in that index.
Okay, and the Nasdaq 100 itself, what kind of companies make that up? What are we actually investing in when we talk about that index?
Right. The Nasdaq 100, it's made up of 100 of the largest companies, both domestic and international, but specifically non-financial companies listed on the Nasdaq stock market. They're picked mostly based on market cap, so yeah, we're talking about the really big players. This structure gives investors really potent exposure to tech and growth companies, but it's also highly concentrated exposure. And importantly, these are often the very companies that are, leading the charge in the artificial intelligence revolution right now.
Okay, so big names, heavy on tech, leading innovation.
Exactly. And QQQ itself, it boasts over $350 billion in assets under management, AUM. That really cements its status as a true giant in the ETF world. Plus, it's consistently the second most traded ETF in the US based on daily volume. That means there's just immense liquidity, really tight bid-ask spreads for traders. Honestly, the ticker QQQ itself has almost become like a brand name, synonymous with big tech for a lot of people.
Wow, $350 billion AUM and second most traded. That's a massive footprint.
Yeah.
So given that focus on innovation, what about the financials? What's really powering this thing under the hood? How's the performance looked?
Well, the performance story is pretty compelling. The underlying index, the Nasdaq 100, it's shown a long-term track record of genuinely superior growth compared to the broader market, like the S&P 500. And it's not just growth, it's what you might call elite quality growth. If you look over the past decade, the companies in the index have nearly doubled the S&P 500's revenue growth. We're talking a 10-year compound annual growth rate, CAGR, of about 9.9% for the Nasdaq 100 versus just 5.5% for the S&P. That's a pretty significant difference.
Doubled the revenue growth.
That's good. Yeah, and that strong top-line growth, it's translated into even more impressive earnings expansion. This is mainly driven by the business models, right? They're inherently scalable, and these dominant tech firms have seen expanding profit margins. Even looking at dividend growth, which isn't really QQQ's main selling point, it still shows a strong 10-year CAGR of 9.9%. That just points to really powerful free cash flow generation by these companies. Fundamentally, these are strong businesses, not just, speculative bets.
Okay, so the numbers definitely back up that story of growth, scalability, strong cash flow. What about profitability? Are they efficient with the money they use?
Absolutely. That's where the quality part comes in. The Nasdaq 100 companies as a group show exceptionally high return on equity, ROE. It's around 40.65%.
0% ROE.
Yeah, it's high. For context, the broader market is usually hovering around, say, 19%. So it's far superior. This high ROE, it's really a hallmark of that quality growth. It means they're not just growing sales, they're doing it really efficiently, turning shareholder money into net income at a, frankly, impressive rate. Now, all this elite performance, this sustained quality growth, it does come with a price tag. It justifies a persistent valuation premium. The trailing price to earnings, the PE ratio for the index underlying QQQ, it's quite high, somewhere in the 36.8 to 42 range. And the price to book, PB, is also very high at 17.3. These numbers are definitely elevated compared to historical norms, even for the Nasdaq 100 itself, and certainly compared to the S&P 500.
Right, so we're seeing companies growing fast, very efficiently, but trading at a premium, which brings us back to that point. What does paying that premium really mean for us as investors? Is it just a cost of getting this growth, or is it something we need to be cautious about?
That's the key question, isn't it? Is this high valuation sustainable? And maybe more importantly, what kind of margin of safety does it leave you with? The current aggregate PE ratio is elevated compared to its own history. Really, the only times it's been this high were during periods of extreme market froth, like the dot-com bubble back in the late 90s.
Oof, okay, that comparison always makes you pause.
Right. It suggests that the margin of safety for investors right now is, well, lower than usual. It means the fund is probably going to be particularly sensitive to any shifts in the economy or just changes in investor sentiment. When you pay such a premium, you're essentially banking on a lot of future good news and perfect execution. There's just less room for things to go wrong.
Makes sense. So we've got the upside, the impressive growth, but also the high cost of entry and lower margin of safety. Let's shift gears now to the potential downsides, the risks. What are the big vulnerabilities here that could trip up this growth story?
Okay, the biggest one, the most significant fund-specific risk, no question, is concentration risk. Consistently, over 50% of QQQ's total assets are tied up in just its top 10 holdings.
Over half in just 10 stocks.
Yeah. Think about companies like Microsoft, Apple, Alphabet, Amazon, Meta, Nvidia. QQQ's performance relies incredibly heavily on just this small handful. So if something negative happens to just one or two of these giants, a bad earnings report, a regulatory issue, it could have a massive impact on the entire fund. Much more than in a broadly diversified index like the S&P 500.
Right. The concentration is definitely something to watch.
And layered on top of that is significant sector concentration. Over 50% is in information technology, another 15% plus in consumer discretionary. This makes QQQ exceptionally sensitive to the broader economic climate. If tech spending slows down or consumers pull back, QQQ is going to feel that much more intensely than the overall market.
Okay, concentration in names, concentration in sectors. But you mentioned earlier there's a kind of aha moment around how sensitive it is to the macro picture, especially interest rates. Can you unpack that connection a bit more?
Absolutely. This is, I think, a really crucial insight for anyone thinking about QQQ. The types of companies in QQQ, these high-growth tech names, are often called long-duration assets. What that means is their valuations are heavily dependent on earnings projected far out into the future. Now, when interest rates go up, the discount rate used to value those future cash flows also goes up. This makes those distant earnings less valuable in today's terms.
So higher rates hurt their present value.
Precisely. And what's really striking here is the historical data. It shows a pretty clear negative correlation between how the Nasdaq 100 performs and changes in U.S. Treasury yields. So if you connect the dots, investing in QQQ is, in a very real sense, making a bet on where interest rates are headed. If we stay in a higher for longer rate environment, that's a significant headwind for QQQ. It makes future earnings less valuable and makes safer investments like bonds look relatively more attractive.
Okay. So that's the aha moment. Your view on rates is almost implicitly tied to your QQQ outlook.
Exactly. Conversely, if the Federal Reserve starts cutting rates, that would likely be a powerful tailwind for QQQ's valuation multiples. It directly impacts how those future growth prospects are valued today.
That's a really important link. So rate sensitivity is key. But there was another big risk you touched on that seems connected, regulation. How does that play into this, especially with these huge tech companies?
Yeah, they're very much intertwined. Those mega cap tech firms that absolutely dominate QQQ, they're under intense and frankly growing scrutiny from regulators all around the world. We're talking antitrust concerns, data privacy rules, content moderation issues. The list goes on.
Right. Seems like there's always a new investigation or lawsuit.
And here's the critical connection. The very thing that has driven QQQ's amazing historical outperformance, the sheer market dominance and massive size of its top holdings, is the exact same thing that makes them prime targets for global regulators. So the fund's greatest strength, that concentration in dominant winners, is inextricably linked to potentially its biggest tail risk.
Wow. Okay. Strength and vulnerability tied together.
Exactly. Any significant negative regulatory action against even just one or two of these key players could trigger a really sharp sell-off across the whole fund. Investors would suddenly have to reevaluate the long-term outlook for the entire sector. And just one more point on risk. QQQ generally has a beta around 1.11 compared to the S&P 500. That just means it's expected to be about 11% more volatile, both on the way up and on the way down. Higher risk, higher potential reward, but also higher potential loss.
Okay, so concentration, sector bets, major sensitivity to interest rates, and this really intertwined regulatory risk, plus higher volatility. That's a lot to consider. Let's zoom out again. Does QQQ have unique advantages that keep it on top despite these risks, especially with competitors out there? Yeah. And what about ESG these days?
It definitely does have what you could call an economic moat, which helps it fend off competition. First, there's just the power of its brand and its first mover advantage. Being launched way back in '99, that QQQ ticker is incredibly well recognized globally. That creates a pretty significant psychological barrier for newer funds trying to compete.
People just know the name.
Right. But maybe even more important is its unmatched liquidity. We mentioned the huge AUM and massive daily trading volume earlier. That creates this sort of virtuous cycle. High volume attracts more big traders, institutions, options users, which in turn boosts volume even more and keeps those bid-ask spreads super tight. This makes it the go-to vehicle for anyone needing to execute large trades quickly and efficiently, or for complex option strategies. Smaller, even cheaper competitors just can't easily replicate that level of liquidity.
So that liquidity is worth paying a bit extra for some investors.
For many, yes. Especially active traders or large institutions, they're often willing to pay QQQ's slightly higher expense ratio, which is 0.20%, precisely because they value that superior trading characteristic, the certainty and efficiency of getting their trades done.
Interesting. So even with cheaper options, it holds its ground. Who are the main competitors then if someone's looking for a slightly different flavor or lower fee?
Yeah, it's definitely a competitive space. There are several cheaper alternatives focusing on similar growth segments. You got things like the Vanguard Growth ETF, VUG, its expense ratio is remarkably low at 0.04%, or the Vanguard Mega Cap Growth ETF, MGK, at 0.07%. And actually, Invesco itself, QQQ's sponsor, offers another fund called QQQM. It tracks the exact same Nasdaq 100 index, but has a lower fee of 0.15%.
Same index, lower fee. Why wouldn't everyone just use QQQM?
Good question. QQQM is generally positioned as being better for long-term buy and hold investors who don't need that ultra-high trading liquidity that QQQ offers. QQQ's massive volume and options market are its unique edge. So despite those cheaper choices, QQQ's brand and liquidity really help it maintain its dominance, especially among traders and institutions. And as for management, Invesco is a huge, very capable manager for passive funds like this. Since it just tracks an index, manager risk isn't really a factor here.
Okay, makes sense. And what about the ESG angle? Environmental, social, governance factors. How does QQQ stack up there? It's important to a lot of investors now.
Right. So QQQ's ESG profile is basically just the sum of its parts and aggregation of the 100 companies it holds. Given that heavy weighting in tech and consumer companies, the fund definitely has exposure to some material ESG risks. Things like data privacy and security are big ones. Labor practices and complex global supply chains, corporate governance issues like executive pay or board independence, those are relevant too.
So potential risks on the S&G side.
Yes, but on the environmental side, it actually scores quite well on carbon metrics. That's largely due to the nature of the tech industry being less carbon intensive than, say, heavy industry. It has a low portfolio carbon risk score, 3.68, and very low involvement in fossil fuels. That earns it the Morningstar Low Carbon designation. And for investors who really want to prioritize ESG even more strongly, Invesco does offer an ESG screen version called the Invesco ESG Nasdaq Q100 ETF, ticker QQMG.
Got it. So it holds its leadership position largely thanks to brand and that incredible liquidity, even with cheaper options available. That's a powerful edge. So let's bring it all together. Given the growth story, the significant risks we've unpacked, the competition, what's the overall outlook? What should investors be thinking about for QQQ going forward?
Okay, looking ahead, the outlook for QQQ is really shaped by this mix of powerful long-term trends, the macroeconomic picture, and those risks we talked about. On the positive side, the biggest potential catalyst is clearly the ongoing development and, crucially, the monetization of artificial intelligence. QQQ's top holdings, NVIDIA, Microsoft, Alphabet, Meta, others, they are right at the absolute epicenter of this AI wave. If AI adoption really fuels earnings growth beyond what's already expected, that could be huge.
So AI is the big potential growth driver.
Absolutely. And the other major potential catalyst would be a clear shift by the Federal Reserve towards cutting interest rates. As we discussed, lower rates directly help the valuations of these long-duration growth stocks. It reduces that discount rate on future earnings, making them look more attractive right now, especially compared to bonds. We could also see a boost if the earnings strength starts to broaden out more in 2025, beyond just the handful of mega caps that have driven so much of the performance recently. More sustainable appreciation across the board.
Okay, so AI adoption and lower rates are the big potential upsides. What about the headwinds? What could potentially derail this or put pressure on QQQ?
Well, the biggest headwind is really the flip side of the rate argument, a higher for longer interest rate environment. If inflation turns out to be stickier than people hope, forcing the Fed to keep rates elevated, that would act as a significant ongoing drag on QQQ's valuation multiples.
Compressing those PE ratios we talked about.
Exactly. Higher rates make future earnings less valuable today, they increase borrowing costs for some companies, and they make safer fixed income investments look more appealing. That can pull money away from growth stocks. Geopolitical tensions and trade issues are also always a risk for these big multinational companies in QQQ. Disruptions to supply chains or global revenue streams could definitely hurt. And of course, that regulatory risk we highlighted. Any significant negative outcome from antitrust cases or new restrictive laws targeting big tech could cause sharp index-wide sell-offs as investors reevaluate the whole sector's future.
It really does feel like this investment case is sitting on a knife's edge, doesn't it? It's
Wow.
not really about finding some hidden value stock. It's much more about reading the big picture, the economy, the Fed, regulation, and understanding this very specific, concentrated structure of QQQ. So with all that said, what's the official recommendation from your analysis for investors considering QQQ right now?
Yeah, finely balanced is a good way to put it. If we pull everything together, the investment case for QQQ over, say, the next 12 months really does seem balanced. Look, it's an exceptional fund. The historical performance is stellar, and the long-term growth potential from tech innovation, especially AI, is undeniably compelling. But,
Ah,
and it's a big but, investors absolutely have to go in with eyes wide open about the concentration, the sensitivity to interest rates, and that growing regulatory cloud.
okay, so for someone who already owns QQQ, maybe as part of a diversified portfolio, what's the advice for the next year or so?
For existing investors already holding QQQ, our recommendation for a 12-month horizon is HALD. Why? Because those powerful long-term secular growth drivers, particularly AI, they do justify maintaining that exposure. QQQ is still a core way to capture tech innovation, and that long-term trend remains very much intact. However, given the full valuation right now, the macroeconomic uncertainty, and that significant regulatory overhang, we'd say now is not the ideal time to be aggressively adding to your position. It's more about holding on to your exposure to the potential upside while being really mindful of the current risks.
Okay, hold D for existing investors. What about someone new? Someone who's maybe attracted by the past returns but is looking at the market now and feeling a bit cautious.
Right. For new investors who have a higher tolerance for risk and are looking out longer term, 12 months or more, QQQ definitely still makes sense as a cornerstone for a growth-focused portfolio. You almost have to have exposure to this kind of innovation engine for long-term wealth creation. However, given where valuations are, a more prudent strategy right now would probably be to wait for a market pullback to establish a position at a more attractive entry point. Maybe look to accumulate shares on weakness. If the market dips on some news or broader concerns, that could improve your starting valuation and give you a better margin of safety. Don't just chase it at current levels.
Okay, so hail D for current holds. Maybe wait for a pullback for new money. That makes sense. So wrapping up, QQQ. Definitely a powerful way to tap into growth, but you absolutely need to understand its unique structure, the concentration, the sensitivities. It feels like it's a bet not just on innovation itself, but really heavily on the macro environment and how the regulatory winds blow.
That's a great summary. And it really leads to an important question for you, the listener, to think about. How do you personally balance that undeniable track record and future potential of concentrated growth against these very real structural risks we've talked through today? Where does your own comfort level with risk meet the market's current valuation, especially knowing how critical the direction of interest rates seems to be for this particular investment?
That's definitely something to mull over as you navigate your own investment journey. And hey, if you want to make sure you get the fastest, most frequent updates on deep dives just like this one, make sure you hit that subscribe button.